All right, Addy John here, and I need you focused for the next few minutes. What I'm about to lay out isn't speculation, it's not theory, and it's definitely not financial fear-mongering for clicks. This is about a critical threshold that has just been breached in the U.S. consumer credit market. Credit card default rates have surged to 15% nationwide, the highest level since the 2008 financial crisis. And if that number doesn't get your attention, Chicago is now reporting a 22% consumer credit default rate. But here's what the mainstream financial press isn't emphasizing. Regional banks are carrying more than $580 billion in credit card receivables on their balance sheets. And 68% of that exposure sits with institutions holding under $250 billion in total assets. These are not the JP Morgans or Bank of Americas of the world. These are regional and community banks already dealing with pressure from commercial real estate losses. Now they're facing a consumer credit shock that could make prior stress events look manageable by comparison. This is not a short-term spike. This is the early phase of a cascading default cycle that can push banks toward insolvency, trigger emergency liquidity responses, and potentially accelerate the bail-in framework that many depositors don't even realize exists. In the next 25 minutes, I'm going to break down why this default wave is structurally different from anything we've seen since 2008. I'll explain how the mechanics of credit card securitization create a hidden vulnerability inside the banking system. And most importantly, I'll walk you through 3 asymmetric moves you need to consider right now to protect capital and position for what could become the largest credit market dislocation of our era. By the end of this breakdown, you'll have a framework that separates signal from noise, along with a clear action plan most investors won't uncover until the crisis is already unfolding. Stay with me, because what we're covering today is not what you're hearing on CNBC, and the positioning window is narrowing. Before we dive into the latest numbers, you need to understand the core framework that governs every modern credit crisis. I call this the credit acceleration model. It's based on a mathematical truth most retail investors ignore. Credit doesn't contract in a straight line. It accelerates exponentially once a certain threshold is crossed. Here's how it functions. In a stable credit environment, defaults occur at baseline levels, around 2 to 3% for credit cards, roughly 1 to 2% for auto loans, under 1% for mortgages. Banks build these expected losses into pricing models through interest rates and fees. But once defaults exceed a critical level, usually around 8–10% depending on asset class, something shifts fundamentally. Banks don't tighten gradually. They slam the brakes. Credit lines are cut. New originations drop sharply. Borrowers who are barely solvent lose access to rollover financing. That pushes them into default. Defaults increase further. Banks tighten more. This is not linear, it's a feedback loop, and once it ignites, stopping it requires major external intervention. The thesis here is simple. We've crossed that threshold in consumer credit. The 15% national default rate and the 22% rate in Chicago are not peak readings. They're early-stage acceleration numbers. And the institutions most exposed are the least equipped to absorb new losses because they're already holding unrealized bond portfolio losses and mounting stress in commercial real estate. The asymmetric opportunity here has 2 sides. First, identifying which assets are vulnerable in a credit contraction and moving before repricing occurs. Second, positioning in assets that benefit from the inevitable policy response, because central banks will respond, and that response historically leans inflationary. Now let's anchor this in history because patterns repeat, and investors who understand them build generational wealth during crisis periods. The first parallel is the savings and loan crisis of the late 1980s and early 1990s. Most people have forgotten this era, but it's directly relevant. Savings and loan institutions, essentially regional mortgage-focused banks, went on aggressive lending sprees after deregulation. They expanded into riskier loans, commercial real estate, and consumer credit. When interest rates surged under Paul Volcker's anti-inflation campaign, the value of their loan portfolios collapsed. Borrowers struggled with higher rates. Defaults accelerated. Between 1986 and 1995, over 1,000 savings and loan institutions failed. The government created the Resolution Trust Corporation to manage the fallout, costing taxpayers over $130 billion. But here's the key insight. The investors who recognized the crisis early didn't just avoid failing banks. They waited for distressed assets to be liquidated at steep discounts. Real estate investors and distressed debt funds acquired assets at 30–50 cents on the dollar and held through recovery. That's how fortunes were made. Credit crises destroy value, but they also create asymmetric opportunity for those who understand timing and maintain liquidity. The The second parallel is the 2007-2009 subprime mortgage collapse. This one is even more instructive. Banks originated trillions in subprime mortgages, bundled them into mortgage-backed securities, and distributed them globally. The assumption was that housing prices would continue rising, allowing borrowers to refinance before adjustable rates reset. When housing prices stalled and then fell, the entire structure unraveled. Defaults surged. Securities rated Tabo AA collapsed in value. Subprime mortgage default rates rose from roughly 6% in early 2007 to over 25% by 2009. Bear Stearns, Lehman Brothers, Washington Mutual either collapsed or were forced into emergency mergers. The Treasury and Federal Reserve responded with TARP, injecting $700 billion into the system. But investors who saw the acceleration model early, those who recognized mispriced risk, generated extraordinary returns. Hedge funds shorted mortgage securities. Distressed debt was acquired at fractions of face value. Understanding the acceleration dynamic created life-changing outcomes. Now let's bring this to today. The current data in the credit card market isn't just concerning, it's historically extreme. According to the Federal Reserve's Consumer Credit Report, total outstanding credit card debt has exceeded $1.77 trillion, an all-time high surpassing pre-2008 levels. The average borrower balance is over $6,500. The average interest rate stands at 22.8%, the highest in over 40 years. And here's the risk point. The 90-plus day delinquency rate is now 15% nationally. In 2008, the peak was 13.6%. We're already above that level, and the trend remains upward. Chicago's 22% serious delinquency rate means more than 1 in 5 credit card accounts are deeply past due. That's not an isolated statistic. It's a warning signal. Why is this happening? 3 structural drivers. First, inflation-adjusted wages have been declining for many workers since 2021. Nominal wages rose, but not enough to offset essentials: food, energy, housing, healthcare. The bottom 60% of earners relied on credit cards to bridge the gap. At 22% plus APR, that bridge collapses quickly. Second, student loan payments resumed after pandemic pauses. Millions lost $200, $400 per month in discretionary cash flow. For households already stretched, this was the tipping point. Third, pandemic-era savings buffers are gone. In 2020, stimulus and lockdown savings pushed the personal savings rate to 33%. Today, excess savings for the median household are effectively zero. For lower income groups, net liquidity is negative. The buffers are exhausted. Debt costs are rising. There's no room left to absorb shock. And that's where the acceleration begins. Now let's examine the banking exposure, because this is where the situation becomes structurally dangerous. Credit card lending is concentrated primarily in 2 categories of institutions: the major money center banks and the regional and community banks. The large institutions have diversified revenue streams, stronger capital buffers, and greater systemic protection. Regional banks do not have that same flexibility. According to FDIC call report data, banks with assets between $10 billion and $250 billion are holding roughly $395 billion in credit card receivables and related securitization exposure. Net charge-off rates at these institutions are averaging 9.7%, approaching levels last seen during the 2009 crisis. But here's the part most investors misunderstand. Charge-offs are backward-looking. They reflect loans that defaulted 6 to 9 months ago and have now been written off after collections failed. The current 15% delinquency rate has not yet fully translated into reported charge-offs. That means losses are still working their way through the system. Over the next 2 quarters, reported losses are likely to rise sharply. Banks are aware of this, which is why they're increasing loan loss reserves. But the pace of reserve building is not matching the acceleration in delinquencies. That gap creates vulnerability. If reserves prove insufficient, banks will be forced to absorb larger than expected capital hits, compressing their capital ratios and increasing solvency risk. There's another structural layer to this crisis: credit card asset-backed securities, or ABS. Banks don't simply hold all credit card debt on their books. They bundle receivables into securities and sell them to institutional investors: pension funds, insurance companies, asset managers. The total credit card ABS market exceeds $350 billion. These securities are divided into tranches, ranging from junior risk-heavy layers to senior tranches considered safer. When defaults rise, the cash flow supporting these securities declines. Junior tranches absorb losses first, but if defaults surge aggressively, even senior tranches can face impairment. We witnessed this exact mechanism during the 2008 mortgage crisis. Currently, spreads on lower-rated credit card ABS have widened by more than 300 basis points in 6 months. That's the market signaling rising risk. If spreads continue widening, securitization markets can freeze. And when securitization freezes, banks are forced to retain more exposure on balance sheet. That ties up capital and restricts new lending. That's how a credit contraction becomes self-reinforcing. So what happens next? Banks under pressure have limited options. They can dramatically tighten lending standards, cutting credit lines and denying new applicants. They can raise interest rates further to compensate for risk, pushing more borrowers into default, or they can seek emergency liquidity support. All three responses are already underway. Credit underwriting standards are tightening. APRs for subprime borrowers are exceeding 25%. And behind the scenes, regional institutions are increasing reliance on Federal Reserve liquidity facilities. The Bank Term Funding Program, introduced in March 2023 following the Silicon Valley Bank collapse, remains operational. Borrowings under emergency facilities have risen 18% in the past 90 days, according to Federal Reserve H4.1 data. That is a clear indicator of growing stress. But here's the real inflection point. What happens if losses exceed reserves and emergency borrowing capacity? That's where the bail-in framework becomes relevant. Under Dodd-Frank and FDIC resolution authority, systemically important institutions can be placed into orderly liquidation. In extreme scenarios, unsecured creditors, including depositors with balances above the $250,000 FDIC insurance threshold, can see deposits converted into equity to recapitalize the institution. This is not hypothetical. Similar frameworks have been implemented in Cyprus, Italy, and Spain. The legal infrastructure exists in the United States. Most depositors are unaware of it, but it is active policy. Now let's discuss the three asymmetric plays in this environment. First, reduce exposure to stressed regional banks. If you hold deposits above FDIC insurance limits at regional institutions, diversification is essential. Either distribute funds across multiple insured institutions or consider allocating some capital into non-bank physical assets. The yield you earn does not justify the asymmetric downside risk. Second, distressed credit and selectively strong financial equities. Not all banks are equally exposed. Institutions with strong capital ratios, diversified income streams, and minimal credit card concentration may trade at crisis-level valuations despite resilient fundamentals. That creates opportunity. Additionally, distressed debt buyers who acquire defaulted receivables at 20-30 cents on the dollar and work recovery processes can generate significant returns. This strategy requires expertise, but the asymmetry is clear during credit dislocations. Third, physical precious metals as systemic hedges. Gold and silver carry no counterparty risk and cannot be subject to bail-ins. Historically, during periods of banking instability and monetary expansion, precious metals outperform. Between 2008 and 2011, gold rose from approximately $800 to over $1,900 per ounce. Silver climbed from $9 to nearly $50. If policy responses include liquidity expansion and quantitative easing, hard assets tend to benefit. Now let's analyze the likely policy response. The Federal Reserve's mandate includes financial stability. If a credit-driven banking crisis intensifies, the Fed will respond. The first line of defense is liquidity provision. That's already occurring. The second is rate cuts. Lower rates reduce funding pressure and debt service burdens. The third and most impactful for asset markets is quantitative easing. If conditions deteriorate, the Fed may restart large-scale asset purchases, treasuries and potentially credit instruments, to stabilize markets. Liquidity injections debase currency purchasing power and drive capital into hard assets. We've seen this cycle in 2008. We saw it again in 2020. The pattern is consistent. The investors who benefit are those who position before the policy pivot is formally announced. By the time headlines confirm intervention, much of the asymmetry is gone. Now here's your action checklist. First, evaluate your deposit concentration risk. Any balance exceeding $250,000 at a single institution should be assessed and diversified. Second, consider allocating a portion of liquid net worth, 10 to 15% or more depending on risk tolerance, to physical gold and silver as systemic hedges. Third, begin researching distressed credit opportunities and financially strong institutions trading at discounted valuations. Fourth, reduce exposure to highly leveraged companies and consumer discretionary sectors vulnerable to spending contractions. Fifth, monitor data consistently. Monthly default reports, quarterly bank earnings, and Federal Reserve policy meetings provide critical signals. Now, I want your perspective. Do you believe the Federal Reserve will intervene early to prevent systemic fallout, or will inflation concerns delay action and allow the crisis to deepen first? The macro community is divided on this question. If you found this analysis valuable, here's what I need you to do. Subscribe and activate notifications. This channel is focused on real-time breakdowns of credit markets, banking stress, and asymmetric opportunities. We move early and focus on actionable insight. And share this with anyone holding significant deposits in regional banks or exposed to consumer credit markets. The credit card default wave has begun. The stress inside regional banks is building. The acceleration phase is underway. The only question is whether you recognize the pattern in time to position yourself strategically. Take action, stay informed.